Okay, afternoon, everyone, and welcome to the next presentation we're doing for the Blockchain Association of the Cayman Islands. So today we're very fortunate we're going to be covering international regulations around digital assets, and I'm sure a lot of you have been wondering what's going on with the different regulations. We've seen a lot happen over the last few years, and we're very fortunate today that we're being joined by Nathan from X-Ray Consulting. Now, Nathan has a very interesting background. He's been in this space for a while. Nathan, I'll quickly hand over to you first, just to give us an introduction, just a little bit about your background, and maybe just let us know when you first were introduced into digital assets and Bitcoin, when you first sort of entered this world.
Great, thank you. First of all, pleasure being here. My name is Nathan. I started my career as an accountant, so I studied abroad in the UK, as many born and bred Gibraltarians do. Studied accounting and finance, and I came back to work for one of the big four accounting firms. So a bit of a interesting start to the career in a very tech-focused industry. So I was working for PwC for about 7 years or so. Partway through my journey through PwC, I did come to contact with Bitcoin, but this was quite early, probably around 2013, 2014. And this was dealing with a Bitcoin fund that was looking to set up in Gibraltar. Back at that time, my partner basically brushed it aside and dismissed it. Bitcoin was only for money laundering. We're not going to deal with that kind of stuff. Very risk averse, and that was the last I thought of it, really, until a few years later. So what happened in Gibraltar, which is quite interesting, is that Gibraltar was quite early on in the crypto regulation. They came up with a regulatory framework. So as from the 1st of January 2018, the crypto companies that were storing or transmitting value in Gibraltar needed this special kind of license. So I guess it was at that time that I started taking things a bit more seriously, given that there was some regulation coming out that this thing was real. So it was about that time that I started doing a bit more research, mainly on the personal side initially. So I started looking into blockchain, Bitcoin, trying to understand what it was all about. And I guess there is where I became, what I like to say, borderline obsessed with blockchain and crypto. So I guess even though accounting and blockchain don't really seem to go that well together, having some sort of distributed ledger for me as an accountant that was immutable and powerful and could run on its own was a game changer. So that's when I got really interested in crypto, firstly on a personal level. Started investing in Bitcoin sort of early 2017, early enough to have made a little bit of money, but not early enough to be a crypto whale. But that's when I got interested in it on a personal level, and I guess professionally, I wanted to really push and really lead on crypto and get involved in the industry early on. At that time, and Petri, I know from your KPMG background, you'd probably agree that the big four, although they're getting very involved in crypto now, at least in the early days, they were quite reluctant to push in this space. And that's when I made the decision that I wanted to work in blockchain full time, really. So I thought it would be really interesting to apply and work for the regulator, something that you don't really hear people say too often, that working for the regulator would be interesting and a great opportunity. But in this case, it was one of the first regulators that were really that built a framework to regulate crypto asset businesses. And that was something that I found extremely attractive. So I moved to the Gibraltar Financial Services Commission, and I spent a couple of years working in a DLT team. So what happened in Gibraltar is that they set up a bespoke sort of like specialized unit that was working exclusively with crypto companies. So we were the DLT team, and we were receiving applications from crypto companies that wanted to set up and benefit from the framework in Gibraltar. We were receiving their applications, we were vetting them, and then once they were licensed, we were also supervising them. So that was incredibly it was incredibly interesting. We met lots of different crypto players of all shapes and sizes, and yeah, it was a learning curve for us and for the entities that were applying to be regulators. But it was extremely interesting, and I'm really grateful for having that opportunity to work at the regulator. And I guess what happened towards the end of my time at the regulator is that myself and a few colleagues thought it would be interesting, and we thought it would be beneficial to share some of the experiences that we obtained by working at a regulatory authority and dealing with crypto companies full time. So we decided to start XReg together. So we left the regulator, we went back into the private sector, myself and a few ex-colleagues, and we set up XReg. So the reason we're called XReg, as you might have guessed, is because we're all ex-regulators. And what we do is we provide regulatory consultancy services, not only to crypto companies, but we also do public sector work as well. So we deal with governments, regulators, policymakers. Recently, I've done quite a lot of work with like FIUs, law enforcement. So yeah, I guess that's me really. I got converted and I went full-time crypto, as many people have done.
Yeah, no, that's very cool. And I wanted you to just give that background because it's an interesting background. I mean, I also had that, you know, that moment when everything clicked and my wife didn't see me for a few days. And then, you know, went through everything, understood everything. And it's great when you really understand everything. So I wanted to ask you, I mean, you guys are now dealing with blockchain companies, you're dealing with different jurisdictions. I know you guys sit on some of the panels talking with the FATF, etc. And I think it's pretty confusing for a lot of people. I mean, there's US regulations, there's every single country has its own regulations. The FATF sits across everything. Can you maybe give us a little bit of a lay of the land, just to explain how all of these different things fit into each other?
Yeah, I can do. I mean, the difficulty with regulation, and this isn't just for crypto, this is generally, that countries really have discretion in setting their own laws, right? Their own frameworks. This isn't unique to crypto. I mean, if you speak to people that work in banking, insurance, in other sectors, even regulated sectors, it's difficult to have this sort of harmonized approach. And as I'm saying with crypto, it's a more of the same. The difficulty with crypto is that it's still quite a nascent industry. Policymakers, regulators, governments are still getting to terms with the technology. Not every jurisdiction is as advanced as the jurisdiction next to it. So we're at this stage really in crypto regulation where you've got certain jurisdictions that have pioneered and they've pushed ahead with frameworks, and you've got other jurisdictions where there may be little to no regulation that directly or legislation that directly applies to these types of activities. The FATF is an intergovernmental body, and they set standards for anti-money laundering and terrorist financing, and recently they also taken on proliferation financing under their remit. There is where you do see at least a level of international harmonization and cooperation, because what happens is that the FATF, it's like I said, it's a group of countries effectively, either through direct membership or through like a regional style bodies. They basically get together and they set standards for money laundering and terrorist financing that countries agree to implement. What happens following the FATF plenary meetings is that countries then need to consider their standards, consider their guidance, and implement it into their local legislation. So what happened with the FATF, which was probably one of the key moments in crypto regulation, is that back in October 2018, they came out with a statement stating that their recommendations apply to virtual assets and virtual asset service providers. So effectively, they were defining what a virtual asset is. They were defining these virtual asset service providers, which effectively are the service providers that interact with the crypto world. And they were saying that our recommendations now apply, or they clarifying that the recommendations now apply to these entities. So effectively, as from that day, they sent a signal to countries that countries need to implement regulatory frameworks for crypto only for anti-money laundering and terrorist financing, which is what the FATF is responsible for. In June 19, they then published some guidance on a risk-based approach to virtual assets and virtual asset service providers. That was also quite significant because they came out with, I think it was about 50 odd pages of guidance to really explain their expectations on countries in implementing the standards and applying them to virtual asset service providers. They also clarified that they expect virtual asset service providers to implement the travel rule, which was a bit of a difficult one at the time, and the industry is still struggling, I think, to get to grips with the travel rule, even though I think we've made some good progress over the past few years. So as from then, really, countries are now being assessed, and countries have always, or since the FATF has been set up, they've been doing these mutual evaluations, and they've been assessing countries against their standards. So by placing virtual assets and virtual asset service providers in scope effectively, there's a big push for countries to implement regulatory frameworks that comply with the FATF standards relative to VAs and VASPs. So again, for me, that was probably one of the key turning points internationally. Prior to that, we had some patchwork regulation. Certain countries, and Gibraltar, where I'm from, they came out with a regulatory framework. You had the BIT license in the US, you had Malta also going for a framework at the time. But this was really a big global international body saying that all countries now need to bring in regulatory frameworks for crypto. So that for me was a huge step in crypto regulation. And as I said, the harmonization is difficult, but at least on anti-money laundering and terrorist financing, you do have these standards being set by the FATF. Countries are being assessed against these standards, so you do have a degree of harmonization. You can have certain countries maybe gold plating standards and going above the FATF recommendations, but if your regime does not comply with the FATF standards, then you can get penalized for not meeting them. So at least it's pushing up everyone to a certain level on the AML-CFT side. So I guess that's where the global pressure is coming from. That's why we're seeing jurisdictions now really taking this seriously and bringing in these regulatory frameworks. But even the FATF standards, they're one of the key phrases in FATF world is risk-based approach. So they require countries to take this risk-based approach to money laundering, terrorist financing. It starts off really with a risk assessment. Countries need to assess what risks they're exposed to, specific to VAs and VASPs, and they need to respond to the threats and vulnerabilities that they identify, and they need to implement regulatory frameworks really that address those threats and vulnerabilities. And here is where you do get some discretion, because based on your perceived level of threats, you can respond in a different way as a jurisdiction. They even go as far as saying that if the perceived level of risk is too high, you could ban activities altogether. They also state that there's also other considerations, not only money laundering, that countries need to take into account as to whether they would consider banning VAs or not. Things like monetary policy, financial stability, consumer protection. These are all areas of regulation that aren't really covered by the FATF. And those are also areas where you see varying approaches by jurisdictions, because there's very little in the way of global standard setting in these other types of regulation. So I guess in terms of the lay of the land, that's where we are right now. We've got most jurisdictions taking the FATF recommendations very seriously. So most international players are now bringing in these regulatory frameworks. We've seen the UK, for example, bring in a crypto asset registration. You've got stuff going on in Australia, Germany. Europe, I guess, is an interesting one, because Europe is where you do have quite a high level of alignment on the regulatory side because of the directives. So these European Union directives do bring some harmonization, and there is an anti-money laundering directive which seeks to align European legislation to the FATF standards, and it applies to European member states. So the last anti-money laundering directive, or I think maybe not the last one, I think the one before that, AMLD 5, did bring into scope some crypto asset activities into the AML framework in Europe, but not quite aligned with the FATF standards. So we do expect there to be another AMLD or maybe even anti-money laundering regulation to really align Europe with the FATF standards. So I guess on the money laundering side, there's a big shift now, and we're not quite there because there are certain jurisdictions that haven't fully implemented frameworks. But that's something that I expect to close over the next couple of years. Where there is disparity is in other types of regulation. So things like consumer protection. Most jurisdictions right now are focusing on money laundering, terrorist financing, meeting their FATF obligations. There's not a lot in terms of other types of regulation. That's something that I expect to pick up over the next few years. So for example, in the UK, there was a consultation on financial promotions, which is sort of trying to protect consumers, but there's no prudential regulation. So there's no capital requirements. There's none of that stuff right now applies to crypto companies. In Europe, there's a big regulatory shift. There's a markets and crypto asset regulation that's going to be coming in, and that really ups the game, and it brings in all types of regulation. This markets and crypto asset regulation doesn't even touch money laundering. This covers things like consumer protection, brings in capital requirements, brings in even disclosures for token issuances, and also importantly, market abuse is something that's still not taken as seriously as it probably should right now by policymakers and regulators. And as you probably know from being involved in the industry, there's still a lot of market abuse in crypto assets as an asset class. So that's something I also expect to see developing over the next few years. So I guess that's the lay of the land right now. You do have certain jurisdictions that are completely banning crypto altogether. So that's also something to bear in mind. So yeah, it's a bit of a minefield right now, and it's a bit of a patchwork of regulations right now. We just need to hopefully get to a point where at least we have a decent level of harmonization in the industry.
Oh, awesome. Thank you. I mean, that's a very comprehensive review. Really appreciate it. I mean, you covered sort of everywhere and exactly how it fits in. We'll get to the travel rule and a few things like that. It's a very interesting, that risk-based approach, and especially that everyone is just KYC AML focused at the moment. That's sort of one of the next things I wanted to get to is, I mean, you're someone that's sat on the other side. You've sat on the regulator side. You've actually done licensing. You've gone through that process. So when you were actually sitting at the regulator, what were some of the challenges that you faced? Because I mean, most people are in industry. We're just seeing the regulations coming in. We don't see the other side of that. So understanding the entities, dealing with the entities, all those kinds of things. What were some of the challenges that you faced while you were on the other side of the table?
I guess there were a few things. For me, the difficulty with crypto, and this is maybe more of a general comment, not just with regulation, is that there's a lack of education. Really, there's very few places you can go to and really have like a library of information that can help you understand this stuff. Mainly on the technical side, I think the regulators are good at what they do. They understand regulation, they understand money laundering, but you're trying to apply these rules to a very different type of asset class, different type of entities. Just understanding things that to me now are basic, but like hot and cold storage, multi-sig keys, private keys, the getting to grips with the asset class itself and what the entities were doing as a business. I personally found that quite challenging. We learnt a lot as we went on. Good thing was, because it was quite early days in crypto regulation, and luckily we had quite a lot of different companies applying for licenses. We got to experience and we got to know firsthand dozens of companies, and we really got to understand quite quickly what good looks like. So if one company has multi-sig arrangements, hot and cold storage, and kept their crypto in or kept their hardware wallets in like a Faraday cage, and the one next to them didn't really have anything, we will start asking questions. So you start really picking and choosing, I guess, the good from each of the entities that we were dealing with, and get up to speed with what good looks like. And it was still early enough that even the crypto companies themselves were learning, and it was still early days in the industry. So I think education was difficult for us. There's a lot of expertise out there, most of it probably in the private sector, but even on the education side, and it's quite interesting to deal with people that haven't been regulated in the past either. So we would deal with companies that were looking to apply for, this was a full regulatory license that required companies to have corporate governance in place, risk management, there were capital requirements, all that on top of money laundering, which was AML regulation, which was a given, really. It was a challenge. I mean, these were very intelligent people that were used to running a crypto exchange in the previously unregulated space, and they were having to comply with stuff that banks need to be doing. So that personally I found extremely challenging as well, and I think some of the companies applying for licenses also found it difficult to transition really from being in the Wild West to being regulated like a bank. So I think, look, I think we did take a pragmatic approach. The regulation in Gibraltar is principles based, so we had flexibility in terms of how we applied ourselves and how the firms could comply, but we also had high standards, and it wasn't enough to have good intentions sometimes in regulation. They needed to really up their game and meet the standards that we had. So I think for I guess the ideal crypto company needs to have that blend of technical expertise, but also know their regulation, especially now that things are changing, and you really need to up your game and make sure you're compliant, especially as more and more jurisdictions are bringing out these frameworks.
No, definitely, and I agree with you. I think that education, and especially the technical education, is really one of the challenges, and that's sort of one of the next things I wanted to cover. I mean, decentralized finance, I think, is one of those really technical things that not too many people really understand. But with the FATF's latest guidance they've brought out for comments, I mean, they talk about decentralized apps in there. They talk about if one component is decentralized, it still doesn't mean that it's not a virtual asset service provider. What do you think these new guidelines, what the impact might be on some of the DeFi applications we know really well and people use day to day?
Okay, so this is an interesting one, and this is where, so maybe to give a bit of background to those listening, the FATF guidance that was issued in June 19, it wasn't until last Friday, I think it was, that they came up with updated guidance. And there's a consultation period of a month where the 50 pages of guidance is now about 99 pages. Understandably, some of them are edits, so it'll probably be less than that. But they've had time now. They've had time to really get to know the industry. They've had time to speak to service providers, to speak to governments, and understand what they've been going through. And it's clear that they've also taken a look at what's out there and what the industry has been doing. And that's really clear in their guidance. So what they've been very clear on now is that their interpretation of what a virtual asset service provider is should be considered very broadly, which means that not only are these custodians and exchanges and custodial wallet providers in scope, which in a way it makes sense for them to be in scope, because I mean, these guys were really doing very similar to what financial services businesses were doing but by virtue of the fact that they were dealing with crypto, they were out of scope of regulation completely. And that personally, I do feel was wrong. And I think the approach that's been taken, especially on these clearly centralized parties, is the right one. If you're a custodian of millions of customer assets, you should have high standards. You should be able to. You should need to protect those assets. Similarly, if you're in the center, if you're facilitating transactions, you should probably be subject to AML/CFT regulation, at least in my view. What seems to be happening now is that the FATF is looking and they're seeing players interacting with these applications, and they feel that if there's a level of interaction that's you are benefiting from it, or you have some level of control or influence on it, you should also be subject to AML/CFT regulation, and you'll also be considered a VASP. And as you point out, they do mention if you, just because you're using decentralized infrastructure, doesn't make you not a VASP if you're not providing these VASP type services. And they make some other quite profound statements in the guidance now, which really suggests that if you are interacting with a decentralized application, if you're interacting with a DeFi system and you're benefiting from it, especially, that's one of the points that you need to consider. One of the key things that they consider makes you a VASP is if you're directly or indirectly receiving income, and that can be made to. And reading between the lines, you can go and start thinking about some of these DeFi governance tokens, for example, where a group develop a smart contract, they release it, but it's powered or influenced by a token, and they might not be profiting on it on the fees side, but they might be profiting on it from price appreciation of a token. All of these sort of things, they're saying that you'd be a VASP. The difficulty here is that if you think about what DeFi is seeking to achieve, it's having this sort of peer-to-peer way of transacting, and making an entity that facilitates that having to comply with AML/CFT regulations fundamentally transforms the offering. So they would have to really identify a customer, they'd have to do due diligence, they'd have to do a risk-based approach, potentially risk classify customers, undertake enhanced due diligence if there's a high-risk customer identified. So all of these things are things that for a custodian with a clear role to bring that in place is not fundamentally changing what they're doing. Whereas with DeFi, it could be extremely challenging for some of these participants to implement AML/CFT regulations. So I guess as an ex-regulator, I do see that even with DeFi today, there are some projects where they're clearly not as decentralized as they probably should be. And if you have that level of control over something, and I'm thinking maybe even projects that have access to pause or change the smart contracts, inputs into smart contracts, even Oracle functionality where you're providing data to a smart contract, and even though it's running on autopilot, they're relying on your inputs for it to function. There are certain DeFi projects out there where there is quite a high degree of centralization, even though they're, I guess, using the DeFi and claiming to be decentralized finance when they're not. So from that perspective, I do see that these groups, by having such a degree of control, there is some responsibility. And there would be an expectation that these parties are responsible if things go wrong. Then there's the crypto bro side of me that does really believe that there is a benefit to society from having truly decentralized and peer-to-peer systems. And I personally do believe that some of these, when designed in a way that avoids centralization, it would be extremely difficult, if not impossible, to impose regulation on these systems. So I think the key thing is, and again, the FATF standards really are imposed on jurisdictions. So countries will need to take this approach and have this wide interpretation of what a VASP is. But I still do see there's still room to have purely decentralized applications, provided that it is actually decentralized and there's no party that can be held accountable for it.
Oh, that's very interesting. And I mean, you bring up a few very good points. I think one of the points for me that's very practical at the moment is in DeFi, because you've got people connecting with their wallets. I mean, at the moment, there's no way to actually apply these AML standards. So what do you see happening there? I mean, you spoke about the travel rule a little bit earlier. And with the travel rule, I mean, the regulations brought it into play, but there wasn't really a solution yet. And we've seen sort of the requirement being pushed out a few times. Do you think we'll see something similar with DeFi if they decide to really apply this, where it's, initially you don't have to do it, but there's going to be a deadline by some point in the future where you have to comply?
Short answer, yes. So I guess if you see what's happened with the travel rule requires, and we won't get into the detail of what the travel rule requires, but it requires certain information to be shared between VASPs, certain customer information, similar to SWIFT in the banking world, where when banks send transactions to each other, they need to communicate and share certain information. These virtual asset service providers need to do the same. The only difference is that with VASPs and with crypto, the value is exchanged or is transferred on a distributed ledger, and there's no clear link between VASPs. So the industries had to come together, and there's various groups developing solutions, but they've had to come together to develop this technical means of transferring this data between VASPs. Understandably, that takes some time to implement, and you can't enforce a requirement until there's actually a technical means of achieving it. With this, the only difference is that if you were to say, we want you to have a broad interpretation of what a VASP is, it's something that won't really require too much technical tweaking on an industry level. So on an individual DApp level, I'd say yes, because it could fundamentally change how certain decentralized applications work. But it's something that will be easier to implement from a jurisdiction perspective, and they could easily push the burden on the industry. I think easier than what's happened with the travel rule. Mm-hmm. I guess so. That's the only difficulty with this. I think the FATF changes to the guidance, though, remember, they're still in draft. There's still a consultation period, so there's still an opportunity for people to respond. But again, I think we know from these consultations that it's difficult to really shift the overarching position. So it does look like it's going to be more difficult to do DeFi unless you're truly decentralized. What we could see happening, for example, is if you want access to connect your wallet to a DeFi application, you might need to do some due diligence with whoever operates the website. Potentially needs to do some due diligence on an individual before undertaking transactions. There are ways of whitelisting certain addresses. So you could see some sort of regulated DeFi emerging, where you do have participants that want to be centralized to an extent to benefit financially from developing these peer-to-peer applications, but will also have to comply with the rules. And I guess you'll also have these pure DeFi projects that are unlikely to be considered to be VASP because they're not performing VASP activities. They're merely developing these platforms and not benefiting from them in any way potentially, which is, again, you start to question really sometimes why people do things, and there's a tendency that that people want to make money, so it's difficult.
No, I mean, the interesting thing for me there is, I mean, you sort of spoke about the centralization, and we saw last year with the OCC in the US, where they said that banks can now custody digital assets. Earlier in the year, they said banks can do transfers and stable coins, and they can host nodes. Do you think eventually we'll see something where in your normal bank account you've got at the moment, you'll be able to get access to DeFi in your normal bank account? So, I mean, that's going through the normal system, and then because everyone's looking for those higher yields, you sort of see, I mean, this is probably a few years in the future, but could we potentially get there where you've got access just in your normal banking checking account to those kinds of applications?
Yeah, I mean, potentially, look, if you look at the way the FATF standards work and the way they've defined VASPs, you could have some sort of hybrid approach, some sort of financial institution that provides these DeFi peer-to-peer services and maybe connect participants, but in a regulated space. So it's certainly something that I think we could be seeing in the future. Mm-hmm. One of the good things with all this regulation is that institutions warm up to it and are more likely to get involved as well. So if you do have the ability to interact with the crypto world from your bank account, it's something that I'm sure many people would take that up.
Oh, that's interesting, and I hope we'll get there eventually. The next thing I wanted to touch on is, I mean, we mentioned doing stablecoin transfers, and we've seen massive increases in stablecoins, the amount of stablecoins on exchanges, and then we've seen central bank digital currencies develop a lot in the last while as well. What do you think is going to be sort of the friction between those two? Because they're almost serving the same purpose. Do you see there sort of being friction between the two, regulatory friction between central bank digital currencies and stablecoins?
I would say that there already is friction between maybe not central bank digital currencies, which are still quite early. There's some early pilots going on, but there aren't any clear usable central bank digital currencies today. But definitely in terms of policy, in terms of monetary stability, monetary policy, there's what I would consider quite a big friction between that and the stablecoin world. And I would say it's mainly because of Libra, now Diem, making that announcement over a year ago now, that they were looking to develop this global type of stablecoin. And we saw the backlash from that. We saw the US, they were worried that they needed to agree on an approach on how to regulate this. Even in the markets in crypto asset regulation in Europe, a big part of that regulation is on asset reference tokens and e-money tokens, and these are basically stable coins. A large part of that regulatory framework is addressing the risk of stable coins, and they even go as far as having these specific provisions for significant asset reference tokens and significant e-money tokens. And once you become significant, there's even more regulatory hurdles to jump through to be able to undertake those activities. So I guess we've really seen a lot of the regulatory responses globally have been focused on stablecoins purely for that reason. I think there's as a government, I would be worried if someone as huge as Facebook instantly allowed people to transact value, potentially using a private type of currency. If billions of users could instantly start transferring this new type of money amongst each other, you lose a grip on your currency. And I think that's something that that policymakers have definitely been worried about over the past few years. So I guess there is that friction already, even before CBDCs emerge. And personally, I do think that's at least the Libra announcement has actually acted as a bit of a catalyst for crypto regulation generally. So by trying to address the risks of a Facebook issuing their own crypto asset or their own stablecoin, I think it's also accelerated other crypto regulation. And I think CBDCs, I think it's something that countries are now probably accelerating their progress in developing CBDCs because they're worried that a big tech company is going to get there before them.
Yeah, no, it's a very interesting dynamic. I mean, we're seeing sort of big tech versus government going up against each other. The other thing that is always interesting is, I mean, a lot of people are still saying that regulations is one of the big challenges for Bitcoin. And as you were saying, where countries they want to control their currency, they want to make sure they can control it. Do you see sort of, I mean, we've seen it 100 times, Bitcoin's been banned by a certain country. But do you think some countries might actually sort of develop their CBDC and then really clamp down with regulations to try and push adoption for that CBDC? And that will eventually have two systems then, sort of a fully regulated and then more of a system that isn't fully regulated.
Yeah, I think irrespective of whether CBDCs take off, I think we're kind of heading in that direction already. So if you look at what the FATF guidance has done, and there's a lot of clarifications not only on the DeFi side, but they're really focusing on unhosted wallets as well. And they do consider, or they do encourage countries to consider whether transactions with unhosted wallets should be considered higher risk. They go as far as saying that VASPs that deal with unhosted wallets potentially can be considered higher risk. So we're kind of already moving to that space where you're going to have the sort of unhosted world, you're going to have the DeFi worlds sitting kind of outside of the regulated space where you've got regulated VASPs, you've got financial institutions dealing with regulated crypto. It seems like we're getting to a point where you're going to have this unregulated versus regulated space. Similar to the traditional world where we've got financial institutions and then you've got physical cash moving around unregulated. And I don't think it's enough to say that everyone that has physical cash is a criminal. That's far from the case. And equally, we'd be able to say the same about crypto. If you're dealing with unhosted wallets and even dealing with DeFi, that doesn't make you a criminal. But you can probably expect to be asked quite a few more questions when you are trying to deposit and cash in on the ether that you've generated from staking on a DeFi protocol, for example, rather than if you already had ether in a bank or in a VASP.
I mean, that process is already painful. So I think in future we can look forward to more documentation and screenshots of exactly where this is coming from. So I know we don't have too much time left. So if anyone who's busy watching has a question, please feel free to post those in the comments section. I wanted to give you a chance to at least give us the positive spin on this as well. I mean, we've gone into quite a few of the other sides. What do you think will be the positive side of regulations for the entire, digital asset industry in the future?
Yeah, I mean, look, regulation is not evil, right? Regulation is there to protect consumers. If done correctly, regulation can really benefit an industry. And again, going back a few years, the crypto world was completely unregulated. Very few people trusted it. I think now, as we see regulatory frameworks start to spring up and start to really take effect, you are seeing consumers becoming a lot more comfortable in interacting with crypto. I don't think we would have ever seen Tesla buy a ton of Bitcoin 5 years ago. They probably should have, because they would have made a lot more money, but they probably wouldn't have been as comfortable. I think now that you've got these regulated players emerging, you do have financial institutions, you do have institutional money flowing into crypto. And like I said, look, regulation is there to protect people. So looking at not only at anti-money laundering and terrorist financing, which is important, and it's there really to protect society, but certain other regulatory frameworks that bring in things like consumer protection, having prudential requirements on custodians, very important. It will help to prevent some of these big failures that we've seen in the past. I mean, you've got exchanges where the founder would go on holiday and supposedly die in India and lose access to their private keys. That's something in the regulated space would be hopefully avoided. And I mean, you do have failures even in the regulated space, but you hope that at least there's some level of efficiency and that will protect people. That being said, look, I do think that there's an opportunity now with crypto to really try and regulate differently as well. And you do hear often with regulation is that people say same risk, same rules. And that might not necessarily be the right way of approaching things. Just because the risks are the same, there's different ways of mitigating risk. And it doesn't necessarily need to be the exact same rules that we're used to in the traditional space as well. So yeah, I guess regulation is a bit of a double-edged sword sometimes. But at least on the positive side, we will see a lot more credibility in the crypto space.
Yeah, no, I mean, I definitely agree. I think the nice part of it will be that consumer protection. I always say I wouldn't have wanted my mom to try and open up a blockchain wallet a few years ago. These days, you've got enough well-regulated, good institutions out there that make it easy for someone like that to access it, and they can get access to all the benefits and everything else, but someone else is taking care of the technical stuff, the compliance, etc.
Exactly.
Just as a last question, I mean, we've sort of spoken about everything. We've covered a lot. Sort of as parting comments, your last words for people looking at the space, looking at regulations, what would you recommend? Should they sort of start thinking forward in terms of where we're going, making sure they're already compliant? How would you say people should think about approaching the whole regulatory space at the moment?
By people, I guess, talking about VASPs or consumers?
VASPs,
or
yeah, mostly VASPs, definitely.
So I guess as a VASP, yeah, I mean, look, one of the things that you need to bear in mind is that this is constantly evolving. I always like to say that it's a bit of a regulatory minefield right now. So you need to be really careful with what jurisdictions you're based in, with what consumers you're targeting, because some regulatory frameworks extend to companies that are targeting consumers from outside. So what I would say is, look, take a look at your business and really think about what jurisdictions you're doing business in right now. Definitely on the AML CFT side, you really need to up your game. You really need to understand and comply with AML CFT regulation. Most VASPs are probably already operating in jurisdictions where there's frameworks in place. But if you're not, it's coming, and you need to gear up, because this isn't something that can be done overnight. So really gear up for AML CFT compliance. And yeah, it's always good to look out at what's coming. I mean, the markets in crypto assets regulation in Europe is going to be quite significant, so it will be useful to understand what's in there. And what I do like about MiCA is that even though when you look at the detail, there may be things that could be done better, the key principles of what they're seeking to achieve, and even comparing back to the Gibraltar regulation, which I was very involved in, there's certain key principles in regulation that will come through eventually. So things like consumer protection, things like having protection over any customer assets, make sure you segregate them from your own funds, start looking at corporate governance, risk management. All of those kind of things will probably come your way sooner rather than later. So it's always useful to understand what's involved and start gearing up for these kind of things.
Perfect. Nathan, thank you very much. Really appreciate it. I mean, this has been a fascinating conversation. It's good to understand, everything and hear it from someone that's sat on both sides of the table. So thank you very much for taking the time. If anyone wants to,
it's been a pleasure.
Yeah, I mean, Xtract.consulting. Thank you very much for everyone who watched the live stream. We're doing these live streams once a month, so keep an eye on your email for this. Please subscribe to our email list, go to LinkedIn, follow us if you want to see all the other interviews, and we'll see everyone in the next one we do next month. Thank you very much.
Thank you very much.